Welcome to the Real Estate Espresso Podcast, your morning shot of what's new in the world of real estate investing. I'm your host, Victor Menashe. This is the weekend edition where we interview notable people from the world of real estate investing. Today's no exception. We have a great guest, but first, a quick thank you to our sponsor. One of my friends in the real estate space, Rod Cleef, is hosting another one of his live events in Denver, May 17th to 19th, and it's all about multifamily investing. I've been a guest on his wildly popular podcast. If you've never been to one of his events, you've got to go, and I highly recommend you do. I've got a discount code that will get you $100 off the ticket price. Go to rodsbootcamp.com and enter the code ESPRESSO at checkout. That's rodsbootcamp.com and enter the discount code ESPRESSO to get $100 off your tickets. We are back here on the weekend edition. We interview notable people from the world of real estate investing. Today's no exception. We have a great guest all the way from Newport Beach, California. Welcome to the show, Matthew Sullivan.
Thank you, Victor. Thank you for having me on.
So, Matthew, you are doing something in the lending space, but it's not traditional lending. But before we dive into that, maybe give a little bit of some of your background and how you got into this particular segment of real estate investing.
Sure. Well, I've always been an entrepreneur in finance, telecoms, and technology for the last 30 plus years. And one thing that really intrigued me about real estate, particularly with the change in securities regulations with the Jobs Act, was how could you build a platform that allows normal investors to get involved in real estate without having to have very deep pockets. So I set up a real estate crowdfunding company about 5 years ago. But as that developed and as I became involved more with blockchain technologies and as the laws moved forward, it became apparent that there was a real need for a solution for homeowners who had or still have trillions of dollars worth of equity locked up in their homes. And we look to find a solution to what we believe is a very big problem in the US.
I love that. And so perhaps like you, I also have a background in telecom. I was in the carrier networks division at Nortel Networks, where I was responsible for their central processors that were involved in controlling the phone network. So that's sure. My background. Great.
I remember the Ericsson AXE10. I remember those great big wardrobes full of flashing lights that we always used to sort of show our clients in. As long as it had flashing lights, you knew that everyone would be impressed.
AXE10 was one of our big competitors.
I'm sorry, I didn't mean to bring that up.
No, that's fine. That's fine. I guess they won because they exist and Nortel doesn't.
That's right.
But okay, so let's dive into this particular segment. You talked about individual homeowners. There's a lot of equity tied up in people's homes, and the traditional path to tapping that equity is to go borrow more money, whether it's a conventional loan, whether it's a collateralized loan, a home equity line of credit, what have you. That's been the traditional pathway. You've come up with something that's a little bit different.
Well, yes. In fact, what's happened is that there's been a way of releasing equity for around 10 years. It goes under various different names, whether it's fractional equity or shared equity. But the contract really allows homeowners to sell some of the potential future upside of their home, but get paid for it now. So they don't sell some of their house, so they don't end up with uninvited guests who want to come and share their spare bedroom. These people don't go on title, but it's a way of saying, well, I think my house is going to go up in the future. And what I'd like to do is get some of the benefit of that future appreciation today, and I'm willing to be paid for that. So what we do is we provide the ability for homeowners to release some of the value in their equity, but without having to go into debt. So the important thing is it's not a debt product. There's no lending, there's no interest payments. And the way that we structure the agreement, we're like silent partners. So we share in the potential increase in value, but we also share in the potential downside if the house goes down in value.
I see. Okay, so let's maybe walk through an example. Let's take a house that has let's say a market value today of $200,000. It's got some equity over and above its original purchase price. So let's say there's an $80,000 loan on the property. It was originally maybe purchased for $100,000, but it's doubled in value. And so there's $80,000 worth of debt, and we're sitting on $120,000 worth of equity. That equity may grow again in the future, and the homeowner wants to tap into, let's say, a portion of that $120,000 or perhaps a portion of the future appreciation. Walk us through an example. How would that work?
Well, the good news is that this homeowner would probably qualify because we have a minimum of 50% equity that we would want in the home. So they've got around 60% equity. Mm-hmm. So that qualifies. And what we would do is we would typically allow them to release 20% as the maximum of the current value of the home. So we would be looking at allowing them to release up to $40,000. Now, there are a number of different contracts that we have that are with different durations. There are some 10 years, some 20 year, and some 30-year contracts, depending on how long the homeowner thinks that they're going to want to stay in the home. And there are different economics attached, but the basic economic is that we will buy that 40,000 or 20% value of your current property. We send an appraiser out so that there's no argument about what the current value is. We have an independent third-party valuation, and we write you a check for $40,000. Now, when you sell your home, which could be any time in the next 10, 20, or 30 years, depending on the contract, we get our initial investment back. So we get our $40,000 back, but we also share in the potential increase in value. So if your house has gone up in value, remember we bought the equivalent of 20% of the increase in value, we would get a slightly enlarged version. Now, that depends on the contract. We could get maybe 3 or 4 times that. So we could get between 60 and 80% of the increase in value, not the overall equity, just the amount that the equity has gone up over that period of time. So you get the $40,000 today, and you can spend it on whatever you want. You can use it to pay down debt. You can also use it to diversify out of your existing equity, which is the single most concentrated illiquid asset that you're probably likely to own. But when you sell your home, if it's gone up, then obviously we share. But in contrast, if it's gone down in value, then we also have the exposure, or as we're partners, we have the exposure to sharing in some of the downside risk as well.
Very, very interesting. So this is kind of a novel concept. I know it's not brand new. How long has this been around?
Well, this type of product has been evolving over the last decade. Recently, it's really begun to get some momentum. So we have 3 or 4 competitors who all do an excellent job. And about $1 billion from institutions has been invested in this type of product over the last few years. But bearing in mind where we are with the economy and the amount of education that's gone on in the marketplace over the last 10 years, we think that this type of mechanism to allow homeowners to release the equity in their home is really going to take off in the very near future.
It's an intriguing story. Now, of course, for the listeners at home, we here on the podcast have not done any due diligence on this. So as always, if you go out and you perform a transaction, get your own legal advice, get your own accounting advice, and make sure you perform your own due diligence. You can't turn around and say, well, I heard this on a podcast, therefore, we're going to sue you. So that's just a disclaimer. But in reality, it's an intriguing concept. It's one that I think certainly has some merit. Let's talk a little bit about, from the lender's perspective, there's a loan of $80,000 on the house in this particular example. Most loans have a covenant that says you cannot, without our permission, put any other form of lien or any other form of secondary financing. How does the homeowner engage in this and stay on the right side of those loan covenants?
Well, again, I think most of those loan covenants are really designed to protect the senior lender so that they don't lose any potential equity or value in the underlying security for their loan. Now, this doesn't qualify will not provide a reason for any lenders to accelerate or do anything otherwise to the loans that would affect the homeowner, because it's a forward contract that is only really crystallizes at the point that the house is sold. And the lien really is very similar to a mechanics lien or a tax lien, for example, where we're not acting in a senior position. It's really like a form of preferred debt. So our team has originated hundreds of these contracts over the last few years. So we've assembled a team of experts in this particular sector. And there's never really been an issue with any of the banks because, most importantly, their security is not affected. There's no change of ownership. There's no change of title. And there's no lien that sits or could potentially reduce their overall security.
Is there any risk? Let's say a borrower has a 25-year amortized loan, but it's on maybe a 5 or 10-year term. And at the end of that 5 years, it comes up for renewal. The lender is going to pull title. They're going to look and see what's on title. Have there been any situations where the lender says, no, I want that lien cleared off title before we record a new mortgage?
Yeah, well, again, we've never come across that. I mean, it's not to say that that may not happen. It depends entirely on the lender, but there's no reason why the lender would have an issue because, I suppose, because title is or liens are often sort of first come, first served, but, it's not something that we've ever come across. And again, we don't normally have any issues with the lender because we're not on title. I mean, we're not reducing their overall security.
Oh, it's an intriguing concept. So what type of project or what type of investment is this product ideal for? What are your customers telling you they want to use this for?
It's funny, the bulk of people that use the money that we release or have released for them through our team historically, the vast majority of people just want to pay down their existing debt. They just want to be debt-free, whether it's credit cards or they want to pay off the existing mortgage. And then there are a number of other people that want to use the money for investment purposes. Because, again, if one is sitting on a large amount of equity, it doesn't really perform very well for you. So our home price movement agreements is a way of homeowners, it enables them to release some of the value that's stuck in that highly concentrated asset. So we have a number of different types of uses. People that want to pay off their debt, people that want to invest money in other more liquid, diversified investments, and also people that just want some cash. Because if you think about a retired person, for example, who may be sitting on hundreds of thousands of dollars worth of equity, we can immediately increase their cash position. So it's a very useful, flexible type of agreement.
I love it. Matthew, folks want to get in touch. What's the best way?
Our website is QuantumRE, which is QUANTMRE.com. There's a lot of information there, videos, podcasts, and other reading material. And of course, just feel free to reach out to us. We'd love to answer any questions you might have.
Thank you, Matthew, for sharing a really intriguing product, something we certainly have not seen before on this show, and I suspect many of our listeners haven't heard of it either because it is fairly new. So definitely reach out to Matthew Sullivan at QuantumRE. That's spelled QUANTM. There's no U. QUANTMRE.com. And in the meantime, have an awesome rest of your weekend. Go make some great things happen. We'll talk to you again tomorrow.